The recent reversal of promising green candles into deep red wicks indicates the presence of institutional liquidity traps designed to stop out retail positions. These sudden drops are the direct result of traders attempting to navigate the crypto market while ignoring the drain on institutional liquidity elsewhere. This image of the traditional trading floor captures the anxiety currently dictating your altcoin portfolio. The S&P 500, an index tracking 500 of the largest publicly traded companies in the U.S., is in the middle of a continuous short-term sell-off. Every time the traditional market takes a hit, the broader crypto market loses the ability to sustain bullish momentum. An algorithmic relationship connects these markets. When institutions pull capital out of traditional stocks, their automated systems apply immediate downward pressure on high beta risk assets. A high beta risk asset is an investment, like Bitcoin, that typically amplifies the volatility of the broader market. When the S&P drops, these algorithms trigger automatic sales in the crypto sector. Relying purely on crypto-specific technical analysis right now exposes you to massive risk. Trend lines on a Solana chart cannot account for a heavy Wall Street contagion pulling the entire sector down. Measuring the downward pressure from traditional equities provides the coordinates for where the crypto market will likely stabilize or break next. Understanding this relationship is the prerequisite for navigating the correction currently in progress. This chart highlights how conflicting data traps retail traders. The long-term weekly RSI, the Relative Strength Index, a momentum indicator measuring the speed of price changes, shows a slow climb from oversold territory. Simultaneously, the 4-hour chart aggressively rejected the heavy resistance zone between $71,000 and $72,000. Market makers use these optimistic long-term RSI signals to encourage retail traders to open leveraged long positions right as the price hits a major resistance ceiling. Following that rejection, Bitcoin is now testing a critical support boundary between $69,000 and $69,500. The liquidation heat map reveals how the market will likely move if this line breaks. This map displays price levels where high leverage positions are set to be forcibly closed by exchanges. The data shows a highly exposed cluster of retail liquidity sitting between $68,000 and $68,700. A confirmed candle close below $69,000 will likely trigger a rapid downward wick, designed to quickly liquidate that dense pocket of leveraged positions. If the $68,000 wipeout fails to absorb the selling pressure, structural support becomes extremely thin. The next established support zone does not appear until the $65,500 to $66,000 range. These market maker wicks occur in seconds, making execution difficult on platforms with shallow order books. Deep liquidity is required to ensure defensive orders execute at your intended price without excessive slippage. Institutional algorithms are actively pulling the price toward that $68,000 liquidity magnet. The Bitcoin dominance metric, which tracks Bitcoin's share of the total crypto market cap, is currently moving sideways. This stagnation means altcoins are completely dependent on Bitcoin's price stability to maintain their own levels. The Ethereum chart shows this structural breakdown in real time. After rejecting the $2,200 resistance zone, price fell and flipped the previous $2,150 support level into a new resistance ceiling. With $2,150 now acting as resistance, Ethereum will likely seek liquidity at lower support levels. The next major zones to watch are at $2,070 and $2,010. XRP is experiencing a similar breakdown. Following a rejection at $1.47, it is currently testing a fragile support level at $1.43 that is likely to fail under continued downward pressure. Breaking $1.43 will likely result in a move through the $1.42 level and a rapid wick down into the heavy macro support at $1.39. Solana has also failed to hold the $88.70 mark, flipping that zone back into resistance. This failure indicates an immediate move toward $86.70, with a secondary contingency floor at $84.50. Across the sector, top-tier altcoins have lost their structural floors. Their price action now hinges entirely on whether Bitcoin can hold above the liquidation clusters revealed on the heat map. In this environment, avoid opening long positions at resistance levels while traditional markets are trending downward. The S&P 500 performance is your primary signal. If the index closes in the red today without a bounce, a Bitcoin move toward the $68,000 liquidity cluster becomes the high-probability scenario for the next 48 hours. Use these identified support levels to pre-place defensive limit orders. This approach removes the need to manually react to high-speed price wicks during a panic. Market survival requires calculating where institutional orders are clustered and positioning yourself at those specific coordinates. Success comes from waiting for the market to move to the data, rather than chasing the daily trend.